Hello, I'm Dr. Richard Tunstall and I'm a lecturer in enterprise here at the University of Leeds. So far through this course, you've identified an entrepreneurial opportunity, reviewed markets and considered the business's operations. We're now going to turn to the vital task of interpreting a business's expected financial performance. While they may not at first appear to be the most exciting aspects of your idea, forecasting and planning are key skills for any entrepreneur or entrepreneurial team to develop. Financial information is important. It provides entrepreneurs with the evidence to support their decisions about a business and helps to justify those decisions when they present them to other people. As the venture begins to trade, they can also compare previous forecasts with actual performance, using financial statements to help improve the accuracy of business planning. In this session, we're going to consider the key basic elements which need to be understood and included when developing an initial forecast. These include a sales revenue forecast, profit and loss forecast, and what is known as a cash flow forecast. Some of these concepts may seem quite abstract, so as you consider each one, I will illustrate them by applying them to an example of a cake stall. Earlier in this course, you considered how ideas might be marketed. As a consequence of this, we now need to think about how we predict what the sales revenue might be from selling and marketing activity. In order to develop a sustainable business, we first need to know what the business will be selling to generate revenue and how much we will charge. Once this is decided, we then need to predict what volume of sales we expect over regular periods, such as a week or a month. By looking at our sales revenue forecasts, we are then able to see how the way in which we market our idea, both in terms of price and number of sales, has a direct financial impact on the business. As a result of this sales forecast, we can then consider ways in which we might need to adapt this idea by perhaps changing the selling price or revising the expected number of sales to see the effect on our total sales revenue. Here's an example. If I hope to sell a slice of cake for £1 each on a stall to local fair, 5 sales will generate a total sales revenue of £5 for the day. If I can increase my volume to 20 slices, I can expect a revenue of £20. But if I increase the price of each piece to £5, I'd only need to sell 4 slices to generate the same sales revenue of £20. Of course, I would need to ask myself whether customers would really be prepared to pay that much for a slice of cake. Now think of some other combinations we could consider of price per unit and number of sales to reach a sales revenue of £100 at the fair. You could also think about how you might encourage people to pay more per unit or buy more units. We're now going to consider how we forecast the business's future profits or losses. While forecasting sales revenue is a useful indication of how much we've brought in from our sales and marketing activity, profit forecasting helps us to assess the financial potential of our overall business opportunity. Profit refers to the amount we have remaining once we've accounted for the costs of doing business. Profit is therefore a good indicator of the viability of our business proposition. In addition, profits can be used to invest in the development of the business or to reward their owners for their investment, so they are often used as a measure of business success. Profits are calculated by taking away the value of costs from the sales revenue. If sales are forecast to be greater than costs, this suggests there will be a profit, which may be a good indication of the viability of an idea. However, if costs are forecasted to be greater than sales, this suggests there will be a loss, which may be a sign that there is a problem with our business proposal. A simple measure of profit, known as gross profit, can be obtained by comparing our forecasted sales revenue against our forecasted cost of sales. This tells us how viable our business idea is. In our example, the idea was to sell cakes. Let's say our cake cost us £2 to make, so if we made 10 cakes in preparation for the day, our total direct cost of sales is £20. We took 8 slices out of each cake and sold each of these for £1. While we're making £8 of sales revenue per cake, the cost to make these cakes means we end up with a gross profit of £6 per cake. If I sell all my available 80 slices in the day, I'll make a sales revenue of £80, but minus the £20 it cost me to make the cakes. I take home a gross profit of £60 at the end of the day. So far so good. However, I also need to include my operational overheads, which I have to pay for regardless of how many cake slices I sell, known as fixed costs. If the organisers of the fair provide the stand tables and some paper plates for free, this doesn't cost me anything. But I'd expect they'll apply a daily charge to use a stand so that the organisers can make money out of the event themselves. If this costs £30 for the day, then bearing in mind that my gross profit on 80 slices of cake was £60, I'll now take home a net profit of £30 for the day. This is still a viable business proposition. So while gross profit indicated the viability of our idea, selling cakes, net profit indicates the viability of our business model, the way we sell cakes. In our case, this was selling slices at a fair stand, but there are other ways I could have decided to sell them which might change my net profit forecast. Indeed, learning about this has also taught us about another business model. Running fairs makes money from charging from stands. Perhaps I should move into that line of business. Now, thinking about everything you've heard about so far, think about how you could improve the gross profit and net profit of our cake selling business. While forecasting sales revenues and profits or losses will provide a good indication about the future potential of our idea, we also need to consider the vital issue of cash flow. If a business were a body, cash would be its lifeblood, and cash is used to pay for a business's costs. Without it, even a very successful and profitable business can fail. A cash flow forecast is developed in order to estimate how well a business will be able to pay for its costs on a regular basis as it continues to trade. Considering our cash flow forecast means that we have to think about the timing of sales and purchasing. We may also need to consider seeking alternative ways to generate cash at times when our sales aren't enough to cover our costs, such as when the business first launches. Returning to our cake stall example, we were pretty confident that our business proposition would be successful if we sold 80 slices of cake every day at the fair. However, before we can sell any slices at all, we need to somehow find out £20 to buy the raw ingredients to make the 10 cakes we need in the first place. If the owners ask us to pay their daily charge on arrival, we then need to find an additional £30. That's £50 spent before we've even sold a single slice. If we were able to pay for this using our personal savings, we can then begin trading and work hard on covering these costs and making a profit from the day. But our business idea then runs into a problem. The highest net profit we can make in a day is £30. But to try to sell 80 more slices the next day will cost us £50 before we begin the next day's trading. Even if we sell out every week, which is rather optimistic, we would always have to find £20 from somewhere else to keep trading each time. Perhaps I'd have to find a part-time job during the week to be able to afford to buy the raw ingredients and keep paying to run my stand every week. Even if I can find an alternative way to find that £20, the business would then be in a cash flow crisis and is suddenly looking like a very poor business proposition. It isn't worth our hard work to run this business, and we need to think again. How can we improve the situation? You might also want to think about this in relation to launching and running your own business, or another example. We've considered a number of key financial forecasts to try and determine the viability of a business opportunity. These have included sales revenue forecasts, profit and loss forecasts, and cash flow forecasts. In the end, it may seem difficult to feel any connection between financial forecasts based on numerous assumptions and your gut feel for an entrepreneurial opportunity you passionately feel is worth acting on. However, using financial accounts to develop forecasts is a useful way to examine the viability of your idea and the way you plan to act on an opportunity. They also allow you and others to evaluate the potential for success as part of an overall business plan. As the business launches, you can then start to evaluate your forecasts by comparing them to statements from your business trading activity to enable you to think about whether your predictions were accurate and how you continue to plan for the future. During this video, I posed 3 questions. Number 1, what would be the best combination of price per unit and number of sales to achieve a sales revenue of £100 selling cakes at a fair? Number 2, how could you improve the gross profit and net profit of the enterprise? Number 3, how could you improve the long-term viability of the business proposition? You might also want to consider these in relation to your own business idea or another example. I look forward to hearing your contribution on the discussion boards below.